Thanks for tuning into Talking Point. I'm your host, Niraj Shah. Our guest today uh, is somebody who I've rarely seen being ruffled. At most times, he seems unruffled in his conversation, in his theories about how he's going about choosing the businesses that he wants to invest in. And I thought the conversation today with Milind Karmarkar should be all about how is he doing his portfolio construction for his clients. Simply because, Milind, good morning. Thank you so much for joining us on Talking Point. It's a pleasure having you.
Good, good morning.
Yeah, and as I was saying, this is important simply because Milind, it it makes sense, or it makes it's very important to try and figure out whether the portfolio construction should be done keeping in mind what will happen over the next 6 months, which is the moratoriums ending, which is the GDP print looking lower, and which is all sorts of issues coming out. Or does it make sense building the portfolio now for pricing in some bit of economic recovery and normalcy maybe in 2021? So, what are you doing?
Okay, so let me put it this way that when you construct a portfolio for long term, obviously, I mean, in let's say in athletic parlance, you should have some athletes who are marathon runners, but there should be some who also run relay races. Though most of the portfolio, according to me, should be for marathon runners, but there should be some where you have athletes who run the relay race and pass on the baton to the next runner. So I think that's the best way to construct the portfolio. Last 6 months, last 4 months, we have virtually seen a reset in the economy, and I think that is how I would construct a portfolio.
Okay, so let's try and simplify this. Two questions. One, um, are you having a higher mix of the marathon runners? I guess the answer is a yes.
Yeah.
But what's the quantum of the relay racers that you believe is apt to have in the portfolio currently? What percentage?
I think at this juncture, at least 25% of your portfolio should be with relay runners, and balance, of course, obviously should be the marathon runners.
And it doesn't worry you that so many people talk about how because the markets have gone up so much, they might correct a bit, and therefore the tactical timing of the relay runners would be better, maybe 5-10% lower, or you not getting into that argument at all?
So, unless and until you are someone who, as currently we hear, that there are a lot of retail investors who have got into either day trading or what they in stock market parlance call BTST, then a 3, 4, 5% drop should not worry, because one thing is definite, that we are still in the midst of pandemic, and it is likely that, like today we had the highest ever cases, which is close to 70,000 if I'm not mistaken, yesterday. So those worries will continue to be there, but these relay racers could do very well over a 5-6 months period, assuming that we do find a vaccine, because I've been reading a lot about that. I've been listening to many interviews. The other day I listened to Bill Gates, and most of them are fairly certain that a vaccine should be available in the most optimistic scenario by the end of this year, and in all probability, or very high probability, of first quarter of next year. So if that happens, then these relay runners, if you have a 5 to 6 months waiting, could do exceedingly well.
Okay, so Milind, I mean, during my entire journalistic career, the one thing that I've learned the most for my uh, personal finance planning or otherwise is that hope for the best and prepare for the worst. I heard you mention two things. One, that the economy's hit a reset and therefore you look at things anew. And two, I just heard you say that maybe the basis of hope is that a vaccine could be available end of 2020 or the first quarter of 2021.
Absolutely.
Since you need to prepare for the worst, are you building the relay racers with the perspective of they performing only in FY22? Because FY21 could well be a washout, even if the vaccine is found out in December.
Correct. So, as you know very well, that stock market basically discounts forward earnings. So, if one is comfortable with that idea, then I think by the end of 21, there is a fair possibility that 22 FY22 earnings would be discounted, and these relay racers or let's say post-COVID players could do very well.
Okay. So can I now that we've established the basic construct, Milind,
Yeah.
can I request that we try and do this next few minutes of the conversation around uh, what are the nature of the businesses or the themes that form a part of the relay racers, and where is it that you believe there are long-term marathon runners? And part three of my questioning, therefore, then would be that which are these long-term things which people are pricing in well right now, where you believe that you would not want to place your bets because you have your own theories. So let's start off with the relay racers, since we've used that term the most.
Okay.
Where do you think there is a chance for alpha?
So I think hotels is an obvious is just sitting there, because I know that this quarter has been bad. Next quarter also could be bad. In fact, Mr. Chatwal in his analyst conference call said that I don't know whether when we will come back to normal, whether it's going to be 18 months, 24 months. So I'm, as I said, that I'm basing my, let's say, proposition on the fact that I do believe that there's a high probability of vaccine being discovered. And once vaccine is discovered, a 30 to 40% inoculation, in all probability, could be sufficient to restrict the virus. And I do expect if that happens, then by March, April, or financial year FY 21-22, we could return back to normal. But much before that, there is a fair possibility that all these stocks which have been hit extremely badly by by travel stopping or because of the coronavirus could bounce back pretty fast, because just a few months back most of these stocks were trading probably 100%, or if not 100%, at least 60-70% higher than where they are now.
Interesting. So would you believe that from a valuation parlance or otherwise, that was the right valuation for the hotel stocks to do well? The reason why I'm kind of asking you, Milind, is this, that there are options available to invest in businesses which are probably certainly going to grow versus you betting on, say, for example, hotels, wherein the growth in all probability will come in, but difficult to quite time that, even if we take into account your thesis about how the vaccine would be found and inoculation would happen and then travel would resume. Because let's face it, the GDP's also had a bit of a hit. People have lost jobs, and therefore the number of people who do discretionary spends would also come down. So my question is only that, what makes you so confident that large hotel companies um, might actually come back to normalcy or near normalcy?
So it's like this, that the whole premise is based that Indian per capita GDP will continue to grow. That is one. I mean, that's the basic premise why all of us invest in the stock markets. So that is one. So I'm not extremely, in the sense that, yes, I do feel sad about people losing jobs, and it's a reality. But I think the jobs will come back fast. And frankly, the jobs which are lost are significantly in the blue collar. White collar jobs have not been lost to the extent the blue collar jobs have been lost. And that is the reason why I think that hotel stocks could bounce back. That is one. Second is, it's also betting on business returning to normalcy. So it is possible that people try and avoid to travel internationally for some time, but something like a staycation, as they call it these days, or travel within the country could become popular. And whatever slack comes in because of international tourists not coming in could be taken up by a domestic traveler. And that is the reason why I think hotels could return to normalcy in about, let's say, from the current level, 12 to 18 months time. But as I said, that since the stock market discounts everything in future. That is the reason why I am saying that they could be the relay race runners, which I was talking about. So that's what it is. And in addition to that, most of these, not most of these, but some of these companies have been focusing in last few years on uh, reducing their own capacity and increasing or growing more on managed hotels. And I think those will be the companies which can do well.
Okay. Okay. So, I mean, just one last question is there, because you do, I don't want to make this a hotels conversation, but are there past learnings from previous such instances which also lead you to believe this? And would you bifurcate between the smaller and the larger groups in the hotel space? And would you bet on, say, maybe the more established chains because people might feel safer going to, an EIH or a Taj property as opposed to maybe some of the slightly and lesser known properties?
So I wouldn't like to take names, but what you're saying is right. I would rather bet on established, well-established hotel companies where people would feel more safe. Coming back to the past, because as I always say that history teaches you a lot. If you go back in history, I don't remember the exact dates, but I think it was somewhere between 2002 and 2006 or 7 that many of, and this was post the 9/11, post SARS coming in. All these hotel stocks did fantastically well. In fact, I do remember some of them going up around 6 to 8 times in a span of about 1.5, 2 years. So yes, hotel stock do bounce back and bounce back pretty fast because beyond a certain limit, what happens is that their ARR go up because of the demand, and that is the reason why they get a significant operating leverage.
Okay. Viewers, this is, I think, a chart that my producer has kindly pulled up. These are stocks of the hotel companies, the two names. And as you can see, I think the point that Milind Karmarkar was trying to make, they had a bit of a flattish 2003-4, but post that, the run up into some of these names was pretty spectacular, 6-7 times for these. Not saying that this is what will happen. I don't think Milind is also trying to say that. But yeah, the past teaches us something. It is to try and learn from the history. Okay, Milind, follow up to these is almost all the other discretionary businesses which might have some of this, post-pandemic behavior possibly hurting them. So I can think of, for example, the multiplex chains, and I don't know how closely you track them, but if you have thoughts there. And part 3 is something that I know you own, and which is the organized retail space. There too, the crowd behavior or the lack of being in a crowd or wanting to not be in a crowd might impact footfalls and therefore offtake. What are your thoughts on both of these?
Okay. So first, let's talk about multiplexes. So multiplexes, yes, they could take some more time, but they also fall probably in the category of hotels and are likely to be one of the, as I said, relay race runners. But I would place my bet more on hotels. But having said that, even there, the similar possibility is there, but initially there is a possibility that their occupancies may not be sufficient to, or maybe just sufficient to cover their costs, because they need to be at least 50-60% occupied. And what happens is that in a hotel, you are in your own private space in the room, while as in case of the multiplexes, you are in a public place. So it will have its impact. So they will also do well probably, but I would bet more on the hotels rather than multiplexes. So that is as far as the multiplexes are concerned. But again, as I said, that yes, they have been impacted significantly, and they are also likely to do well. Coming to the retail space, yes, in our initial estimates, we had thought that retail will, slowly come back to normal somewhere in the second quarter. That doesn't seem to be happening. in all probability that has been pushed to the third quarter, or more likely in the fourth quarter. I would give more sort of credit to organized retail, because it is easy in organized retail to focus on social distancing, to focus on all the other to keep a watch on all the other aspects of maintaining hygiene, rather than in the other formats. And that is the reason why I do expect that, again, as I said, that all this is dependent on whether the vaccine or a treatment is found. But with the kind of talks I have had with many of the retailing companies, they are seeing customer footfalls already. And many of them believe that towards the fourth quarter, they should be back to normal.
One final question on this, Milind. And since both of these spaces, unlike hotels, are facing disruptions of something that they haven't, right? With, I mean, JioMart and Amazon, etc., coming in, and organized retail, one has that issue, and two, even on the exhibitor space, now that movie debuts are happening on digital platforms, and that might rob the multiplexes of that. Are these significant challenges, or you think that they will be overcome?
As far as movies on digital platforms are concerned, I think it will not impact that much, because ultimately, once the fear of infection goes away, people would like to go back to the movie experience. And that is the reason why I think it will not be that much of a problem, because already people have had an overdose of digital platform, according to me. And everyone would be earning to go and watch a movie in the theater. And in all probability, this urge will drive subsequent growth in the multiplexes as well. Coming to retail, sorry, I missed your question. What was the question on retail?
Just that, with Amazon and Flipkart having already been there, but with JioMart now flexing muscles in a big way, how did it impact organized retail?
Got it. When it comes to retail, though it's true that it's very easy in a pandemic to order for even a bread on JioMart and you get it at your home. But all said and done, this is being done because of compulsion. I mean, getting boxes from Walmart every day, frankly, and disposing them is a pain over a longer period. So, and the experience of going and buying your own stuff, looking at your own stuff and buying what you want is completely different. And I don't think that is going to change so soon. Though I do expect that businesses in the retail space will be omni-channel. So when one says that take any, whether it's ABFRL or whether it's Trend or whether it's Avenue Supermarket or Star Bazaar, all of them will have a brick and mortar presence, and they will also have a internet presence, and both will work.
You reckon they're lagging? Milind, you reckon they're lagging because on the internet presence, because they've not quite made a headway? Is there a reason why, or is it that these companies believe that they don't need it?
So when I discuss it with these people, one thing is there that globally a model which sells grocery on retail has not been profitable so far, for simple reason that it takes a lot of effort to collect what is ordered by a customer and to deliver it to them. So that is the reason why it's not a great model, at least up till now. But having said that, most of them have realized that they need to have a channel where people can order online and get things delivered at home. So they're working at it, but you're right, they are slow. Like sometimes I talk to them, I discuss with them that especially in a city like Mumbai, what is essential is home delivery. So a customer will go to the shop and do whatever shopping she wants, but she would prefer to get the goods delivered at her home. So I think ultimately that will be the model which will prevail. So either she will shop on the net, or she will go to uh, the uh, the large format store and buy it from there. But delivery will have to be done at least in large metro cities like Mumbai.
Okay.
So
Well,
it
let's
will be
wait
a
and watch how
combination.
that.
Yeah.
Yeah. Okay. Fair call. Milind, so have I missed any relay racers in my quest for questions, and then we can move on to the other thing.
There could be, but I think some of them have already moved. Like fertilizers was an interesting space some time back. As most of the fertilizer companies had done well. But I think they have already moved by close to 50-60%. So from this level, I don't know. But there are commodities. But then again, I'm not a commodity player and I don't understand them. That's why I'm not commenting on them. Airlines could be, again, interesting. Having said that, I don't like that sector because I prefer to have companies with low debt. So that is why even those companies don't fit into my criteria. But otherwise, those are the ones which could benefit because of the number of players going down. So the existing players could do pretty well going forward. So that is one thing which one will have to keep in mind while looking at these players. And of course, oil is down. So it could be interesting to see how airlines do going forward.
Sure. Okay. Fair call. Fair call, Milind. So that's part one of the conversation. I just want to viewers. So remember, we were trying to bucket this into three, right? We've spoken about the businesses which could have this big alpha or an uptick purely from the economy moving up and business and things returning to normalcy some point of time. What about uh, things which are kind of stable throughout the investment cycle? Milind, what is it that you thought was a part of your portfolio before pandemic and you would believe would continue to be a part of your portfolio post pandemic because they seem to be evergreen businesses?
So, as you know very well, consumption will be a part of my portfolio and it will continue to be the part. So, whether it's retail, whether it's fast moving consumer goods, whether it's white goods, they will continue to be a part of my portfolio. Even pharmaceuticals. So, pharmaceuticals, if you see over a longer period, in 1990s, these companies started their business and many of them went up 60 to 100 times, and then they were doing pretty well for a long time. Then they initially started with India, then moved to US, and they did start their exports also. Then they went into a stagnation, but again 2005 to 2010 to 2015 they went up 4-5 times. But after that, we had US FDA coming in, and because of that, there were surprise inspections, and a lot of people had issues with not working on processes correctly, and so on and so forth. And because of that, many of them got 483 observations, and because of that, most of the pharma sector went into a tailspin. But if you look at so between 2015 and 2000, towards the end of 2019, all of them have did not do pretty well. But after that, we have seen that most of these companies have got their act together, have cleared their manufacturing facilities, and have started again exporting to the world. And I think there is a big opportunity. So pharmaceuticals is something which should be a part of one's portfolio over a longer period of time. So yes, pharmaceuticals would be one of them which have been a part of my portfolio, but maybe a couple of names, and maybe going ahead we would add some more. So we would increase our weightage on pharmaceuticals. Coming to financials obviously have taken a big hit during pandemic and post moratorium. It's likely that many of them will have some issues regarding NPAs and so on and so forth. But I think the best names will continue to do well. So they have already come down, and I don't expect them to go down further, even if their NPAs rise a bit. But over a longer period of time, if you believe that Indian economy is going to do well, and if you believe that per capita income is going to go up, these strong names in, especially in the private sector, in banking and finance, are likely to do well, and that should also be a part of your portfolio. Uh, they have been a part of my portfolio as well, and they should continue to be a part of your portfolio.
Got it. What about information technology? I didn't hear you mention that. What about those businesses? Because
So,
everybody seems to believe that telecom, media, and technology are the three things that have emerged stronger out of the pandemic.
So let me not talk about media and telecom, because again, I believe that telecom uh, is a utility and should be valued at that. So let me keep aside the telecom. Media, again, I don't understand, because a lot depends on the content. So I'm keeping that aside as well. When it comes to information technology, if you see in last year to date, let me put it that way, or especially in the last quarter, the kind of results which so-called FANG companies in the US have shown are fantastic. So you can see stocks like Facebook, Amazon, Apple, or Netflix. They have done phenomenally well. Their top line has grown anywhere between 29 to 100%. Same thing is true with their bottom line, and uh, their kind of returns which they gave in the month of July was anywhere between 16 to, in case of Google, it was negative, because they did have a negative growth. When it comes to Indian companies, there is a basic difference. I think that Indian companies are basically software services companies, and their benefit or their profitability predominantly comes from the arbitrage between the salaries which are paid in India and salaries which are paid in the United States. So of late, if you see for last 5-6 years, they're growing, but their growth has been comparatively lackluster. So when I say comparatively lackluster, it's like this: that if you have an economy which is growing at about 6.5%, which I again hope will happen by FY22, and if you have a inflation of about 5-6%, then your overall economy is growing at about 12-13% naturally. So if you are a company which doesn't grow by more than 15% year on year, I don't think it's a great space to be in, because you may ultimately end up losing money. This I am talking with a view of a long-term portfolio
Okay.
creation. So, in the shorter term, yes, I have been proven wrong, and they have given fantastic returns. So, like if I look at, say, Infosys in dollar terms, quarterly numbers are sales minus 0.3%, profits plus 3.8%, TCS negative growth, Tech M 5% top line growth, 5% bottom line growth, HCL Tech 0.3% top line growth, 20% bottom line growth. But there again, this is also because of acquisition. So, in terms of stock market performance, Infosys up 34%, TCS up 10%, we have Tech Mahindra up 24%, and I think HCL Tech is also up 25%. So in the shorter run, they have done fantastic. They have given they have given unbelievable returns. But will they be a part of my long-term portfolio? I'm talking in general, not the name specified, but in general about the software services companies, because it's very, very rare to find a company which is into pure product, a product company in India. If they are able
That's true.
to move to a product development, then probably some of them can do very well. There is no dearth of talent in India, but the issue is that would you sacrifice short-term returns or short-term growth for long-term benefits? That's the only call which some of them may have to take. Some of them may take over a longer period. But as of now, if it's based only on differential between salaries or differential between earnings, then I think this business model is not a great business model, because at least I am confident that when you compare the per capita income growth in India vis-a-vis US, we will far outstrip the US over next 8-10 years, and that could have an impact on profitability of these companies. That's my view.
Okay, fair call. I was just wondering, actually, just last couple of questions then, Milind, and just one is a quick follow up to this point on IT. You don't reckon that because of the change in mix of business, if you will, because there is a lot of small businesses happening right now, and if IT companies world over scale back their IT departments, then work for these companies might move up, and two, could valuation multiples move up for them?
So I doubt about valuation multiples, because I think valuation multiples would depend on top line growth. So if they are able to at least last 4-5 years indicate that it's going to be tough for them to deliver a good top line growth as compared to what their earning multiples are currently. So if they deliver big top line growth, then yes, what you are saying is absolutely right. But in my opinion, as of now, it doesn't look possible. That is one.
Okay.
So that is the reason why I think that they are great companies, they are great management, but the environment is not good. Let me put it that way.
And it's a good company need not be a good stock to buy in your portfolio any which ways. Just one last thing, Milind. Anything that the COVID period or the last 3 months changed for you in terms of the business and the way you looked at it? Like, I mean, I'm just using examples, right? Back-end manufacturing, because of the outflow from China into India or what have you, or the import duties levied, became a reality and a buzzing space. Hand sanitizers has become this very large category. I was reading estimates about how it could be as large as the organized decorative paints industry in a couple of years' time. So my question is, have you seen anything which you believe in a post-COVID world is a large industry or a buzzing space in which you would want to invest into from a long-term perspective?
So hygiene is something which will become pretty large, and I think that is very good as far as India is concerned. But most of the players in this would be, in all probability, FMCG companies. So their growth rates could accelerate further because of this focus on hygiene. But besides that, any new company, I don't know, because there were a couple of companies in isopropyl alcohol manufacturing, and they have already moved up quite a bit. So again, I don't think hand sanitizers will become very large over a period. But because after some time, what happens is that the habit of washing hands will remain, but whether use of hand sanitizers will continue post COVID, I have my doubts on that. But yes, washing hands, keeping or maintaining hygiene, these things will definitely be there. And that is the reason I think that some of the FMCG companies are likely to do pretty well.
Interesting. Milind, always a pleasure talking to you. And today I'm glad that we just didn't speak only about consumption, but a few other pockets too. So with you, a conversation is never complete without consumption. So I'm glad we got that as well. But thank you so much for joining in today. I appreciate your time. And viewers, thanks for tuning in to this edition of The Talking Point.